On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
Morning team, hope everyone is well. Before we get into it, one important message. This will be the last time you'll hear from me for a couple of weeks. As of now, it is the April school holidays for the next 2 weeks, and as is always the case, I take the best part of that period off work and go on leave. So I won't be recording any podcasts for another fortnight, but I will be back, so never fear. Anyway, let's look back at last week. It was a bit of a volatile one, and then we will turn our attention to what is coming up in the days ahead. We had another stronger than expected inflation report in America, and that did rattle investors, and it did see interest rates rise, and it pushed out hopes for interest rate cuts. They're still on the horizon, but they might be a little bit further away than markets were expecting a week or two back. So we'll talk about the detail of that shortly, but that was the backdrop for the moves we saw last week. The S&P 500 index in the United States was down 1.6%. That's its worst week since October. European shares were down 0.6%, emerging market shares 0.4% lower, and the local NZX 50 index slipped 0.7%. Japanese shares bucked the trend. They were up 2.1%, and Australian shares were also up slightly, up 0.2%. Interest rates a little bit higher. The US 10-year Treasury yield rose from 4.4% to just over 4.5%. That largely came on the back of that hotter inflation report. So the 10-year yield is now sitting at the highest we've seen since November last year. And here in New Zealand, the 5-year swap rate, which is an important wholesale rate, important for mortgages, important for fixed income yields, that interest rate rose from 4.4% to 4.69%. So the move was bigger here in New Zealand, and that interest rate ended at a 7-week high. Looking back at some of the key releases, we will start with that US inflation report, and this was for the month of March, and it was the third month in a row where we saw inflation come in higher than expected. So the headline and the core CPI, Consumer Price Index, both increased 0.4% for the month, and both were expected to rise 0.3%. So not a huge difference, but just enough to remind people that inflation is still problematic. The annual headline CPI increased 3.5%, so that was actually the highest in 6 months. And if you look at a chart of inflation, and I put this in the report that you can find on our website, the week ahead report that I do every weekend, you'll see quite clearly that after peaking at 9.1% in 2022, which was the highest since Ronald Reagan was in office, interestingly, so the highest since the early 1980s, inflation in the US came down quite sharply. So it fell from that 9.1% peak in 2022, and it came down to about 3% 10 or 11 months ago. So the Fed wants it to come down a little bit more than that. Their target is 2%. And while they've made some great progress getting inflation from as high as 9% down to the 3s, they're struggling to get it from 3.5% down to 2 or 2.5%, where they would like it to be. So that did spook markets just a little bit. And when you look at supercore inflation, which is what they consider to be services inflation, excluding food, energy, and housing, so it's a way to isolate some of those more persistent inflation pressures. That measure increased at an annual rate of 4.8% in March, which is actually the highest we've seen since April last year. So that measure of supercore inflation has been picking up again. over the last 3, 4, 5 months. So that's where we're at, and that's why you saw the reaction that you did last week. Interest rates up a little bit, the US dollar up a little bit, and that happens because people expect the Federal Reserve to hold rates higher for longer. So it's positive in sense of the US dollar providing an attractive yield on cash and on short-term money market investments and so forth. So that's why the New Zealand dollar was down a little bit against the US. Most currencies were, in fact, and you saw volatility across the share market. So hopes for a June rate cut from the Federal Reserve fell quite sharply, and markets now don't see much chance at all of that happening. They see about a 60 or 65% chance of a cut in July. So they've pushed that out sort of a month, and you've got to look out to September before you find a time when the market is quite confident that the Federal Reserve will cut interest rates. So you only need to look back a couple of weeks, and a June cut was priced in quite aggressively. Markets saw that as not quite a done deal, but pretty close to a done deal. And now instead of June, we're talking about September, maybe July. So I guess when you think about that from an investment perspective, nothing's changed really. At least in a longer term sense. Rate cuts are still on the horizon. They are still coming over the next several months. Instead of June, it might be July, it might be September, it might be October, who knows? And we might not get as many rate cuts this calendar year. The market now sees just 2 rate cuts. At the start of the year, they expected 6 or 7. The Fed was saying 3. The Fed is still saying 3, but the market is now thinking 2. So that is the backdrop. I don't think it means we should change our investment strategy. Interest rates are still at a peak, and the next move is likely to be down. It's just that down move will take a little bit longer. 3.5% inflation is certainly not the end of the world. Inflation at 5 or 6 or 7 or 8%, that's a real problem. At 3.5%, well, that's kind of an annoyance. We'd rather it be 2.5%, but it's still not terrible. So no need to panic. And I think the other really important point to make is that this goes hand in hand with a strong US economy. Cast your mind back to a week ago on this exact same podcast, and in that episode we were talking about a strong jobs report in the US with more jobs being created and the unemployment rate falling a little bit. We were talking about the ISM manufacturing index, which was much stronger than expected, and all of that was telling us that the US economy is in much better shape than people expected it to be. And that sort of environment goes hand in hand with more persistent inflation. We can't have our cake and eat it too. We can't have inflation coming down in a straight line and the economy remaining strong. So we've got to take the good with the bad. Strong economy, good for corporate earnings, good for economic activity, but we are having to tolerate some of this more persistent inflation, and that means that interest rate cuts might take a little bit longer to emerge than we expected. Crossing the Atlantic last week, we had an ECB meeting, a European Central Bank meeting, and that was really the key event. The ECB left interest rates at 4%, and they've been on hold now for 5 meetings. So that was the 5th meeting in a row that they were on hold. Bit of a different story when you think about inflation in Europe. In contrast to the US, European inflation has been coming down more quickly than expected because the economy has been a little bit weaker than we've seen in the United States. So the headline inflation rate fell to 2.4% in March, and this was north of 10 in 2022. Now it's down at 2.4. So it's at the lowest levels we've seen since July 2021, almost 3 years ago. A couple of weeks ago, people expected a June cut from the ECB and the Fed. Things have changed for the Fed. They now see that as being a little bit later in the year, but June still looks like the time when the ECB is quite likely to cut interest rates for the first time this cycle. In fact, markets see a 95% likelihood of a June rate cut from the ECB. So that's not far away. Markets also see 3, maybe 4 rate cuts coming this calendar year. So that's something we need to think about. It'll probably be a positive from the perspective of European share markets, especially those more interest rate sensitive parts of the market. it will probably mean the euro does struggle a bit and that US dollar will remain much stronger. I think we have some new CPI figures in Europe this week. Yeah, we do, on Wednesday. So we'll get a new inflation report this coming week out of Europe. But that's where the ECB is at. They are relatively comfortable with how things are going, and they are still feeling that they are in a position to start easing monetary policy slowly, beginning in June. Right, here in New Zealand, the Reserve Bank of New Zealand was absolutely the main event, and as expected, they made no change to the OCR, left it at 5.5%, the highest since 2008. It's been at that level since May last year, so it's almost a whole year that it's been on hold at 5.5%. That was as expected. And we didn't get a whole lot of new information at this meeting either. It wasn't a monetary policy statement, which means we didn't get a new set of forecasts and projections to consider. And there wasn't a press conference for us to watch and observe the body language and the answers to some questions from journalists and that sort of thing. So all we got was the one-page statement, and it was pretty similar to what they said in February. In short, the Reserve Bank thinks that it is on track, but it's also holding its cards quite close to its chest. Its last forecast set suggested that the inflation rate will slow to 2.5% by the end of this calendar year. Now, they next meet in May, then they meet in July, then they meet in August. And it's that August meeting where financial markets see the first potential timing for an OCR cut. However, markets are much less confident about that now. A fortnight ago or even a week ago, markets saw a very good chance of a cut in August, and now they're sitting roughly around 50-50. So I think that is a reaction that came on the back of what you saw in the United States and with the Federal Reserve, and because the Reserve Bank didn't really give too much away at that meeting. So 50-50 in August, and later in the year is seen as a time when it will be more likely to get that first OCR cut. I think we will have to watch the next couple of inflation reports quite closely, and there's one coming up this week that we will talk about very shortly. In fact, we'll talk about that now because that was the crux of it last week. So we're on to the week ahead. And yeah, like I said, it'll be that CPI release here in New Zealand that will be the key thing to watch, in my mind anyway, and certainly for people that are focused on what's happening here at home. This will be out on Wednesday, 10:45 a.m. And this will cover the March 2024 quarter. So remember, we get our inflation reports quarterly. In places like the US and Europe, you get monthly inflation, but we haven't had one for a good 3 months. So looking forward to this. The last inflation report we got covered the December 2023 quarter, and the annual headline inflation rate was running at 4.7%, which is good progress from the peak this cycle, which was 7.3%. I think that came in 2022 or early 2022, I think it was. So we've come down from 7.3 down to 4.7, and this week Reserve Bank projections suggest that it will come down further. They're at 3.8%. That's what they had in their February monetary policy statement. So that would be the first time it's been in the threes for a little while. Financial markets and all the economists out there, they see it coming down, but not quite as much. And remember the economists out there, they have the luxury of changing their mind and reviewing their forecasts every time new information comes to light. So they've been able to look at what we've seen with oil prices going up, with the Kiwi dollar going down, and adjust their forecasts, whereas the Reserve Bank forecasts I'm talking about are still from February, and they might have changed their mind too if they'd updated them since then. So Reserve Bank sees inflation coming down to 3.8. The economists see it coming down to 4, which is still progress. That's still a good leg down from 4.7%. But this will be important as we all look ahead to when the Reserve Bank might cut the OCR. There's this inflation report, then there's another one in mid-July, and I think the Reserve Bank sees it coming down sort of into the low threes, so we'll see how things go. But look, I suppose looking out 9 months, 12 months, we're very much on track for inflation to be back in that 1 to 3% range. So it'll just be about where this one lands and what the detail looks like. But Wednesday morning, if it's 4, that would still be good progress. If it comes in the high 3s, I think that would be very pleasing to financial markets and to the Reserve Bank. So that's the key thing here in New Zealand. Not the only thing, but the key thing. We also have a dairy auction. This will also be on Wednesday, much earlier than the inflation report. Early on Wednesday morning, we'll get the results of the latest global dairy trade auction. A fortnight ago, we saw a welcome reprieve from the weakness of the previous month. So the headline index a fortnight ago up 2.7%. That was the best gain since early February, and it came on the back of a nice increase in whole milk powder. So the global dairy trade index is up 5.8% this year, and the Fonterra payout is expected to be $7.80, give or take. So looking for an update in that regard. Also on Wednesday, we'll get another housing market report. This will be the Real Estate Institute housing market report, which is one of the best ones, 9 a.m. on Wednesday, and this will cover the month of March. It was a slow start to the year for the housing market after things stabilised over the back half of 2023. Slow start to the year, but the February report did have some bright spots. We saw a nice jump in sales volumes and prices ticked a little bit higher. Be looking for any evidence that things have maybe stalled. That's what I'm hearing from a lot of the agents out there, that things have stalled quite a bit, although I think it's very patchy. There are parts of the country that are actually going okay, and there are other parts of the country where things are quite sluggish. So generally the housing market has stabilised and it's back on the up, but it won't be a dramatic up. It'll be sort of a steady, gradual rise. So if you're a first home buyer, probably a bit more of a buyer's market than a seller's market. No need to worry about another decline. I think those are behind us for the time being, and prices will push a little bit higher. But at the same time, you also don't need to worry that things are going to dramatically get away on you. I can't see prices rocketing up again with mortgage rates where they are, with unemployment rising a little bit, with people still under a little bit of pressure. But migration's strong, that's a good thing, and you have had some policy changes that are positive for the housing market. So it's kind of a mixed bag. You've got some tailwinds and you've got some headwinds. Internationally, the key releases will be out of China. We'll get some fresh activity indicators on Tuesday afternoon, industrial production, fixed asset investment, retail sales. We'll also get the quarterly GDP report for the March 2024 quarter. So that will be interesting. I think the market is looking for 5%, which is pretty much in line with what the annual growth target is for 2024 in terms of the calendar year in China. So be looking for new information out of China. The more recent data has actually looked okay. Some of the March data looked quite strong, but January and February were pretty weak, and you've still got that property sector that is incredibly problematic in China. So I find it hard to get excited about the short-term prospects for the Chinese economy, but this will still be worth watching. Like I said, we'll get those European inflation figures. We'll also get some UK inflation figures out this week, so those are worth watching. And in the United States, there is quite a bit going on, and this will all be interesting, especially after last week with that hotter than expected inflation report, especially with some of the stronger economic indicators that we've seen, and with markets questioning what we might see from the Federal Reserve over the balance of the year. We will get retail sales on Monday in the US. We'll get industrial production on Tuesday. And there will also be a few high-profile Federal Reserve speakers that we'll be watching, including Fed Chair Jerome Powell. Powell is speaking on Tuesday in a fireside chat with the Governor of the Bank of Canada. I think that's in Washington, D.C., and that might be sort of as part of the IMF spring meetings. So that's on Tuesday, Powell speaking. And we will also hear from Fed Vice Chair Philip Jefferson. He's also speaking on Tuesday, giving a keynote speech somewhere on monetary policy. So this will be interesting because we'll want to see whether Chair Powell and the other Fed members out there believe these recent inflation figures could see the Fed take a more cautious path, whether it could mean some of those rate cuts are delayed. That is what we've heard from some of the other Fed speakers lately. I talked about that a week ago. So we'll be interested to hear Powell's take on some of those recent indicators. And last but not least, we will have the international reporting season ramping up. I think there's more than 40 S&P 500 companies scheduled to announce results, and across plenty of sectors, plenty of different businesses, so lots to watch. You've got Goldman Sachs, you've got Bank of America, Johnson & Johnson, United Health, ASML, LVMH, Netflix, TSMC, that's Taiwan Semiconductor. That's a really interesting one. That's definitely worth watching. Procter & Gamble as well. So a good spread there. Reporting season off to a bit of a rocky start with the US financial heavyweights on Friday night. JP Morgan came under a little bit of pressure. I think that was about the outlook. Maybe that's a shot across the bows for the rest of this reporting season, with markets having performed pretty well over the first 3 months of this year. I know we've seen a little bit of weakness creep in more recently, but markets are still not far off those all-time highs, and they're certainly well above where they were at 6 months ago, 12 months ago. So the bar is still quite high for companies to deliver and to meet these quite lofty expectations, not just in an earnings sense for the quarter that we're talking about, but in terms of the outlook as well. And in some ways, a bit of volatility, a bit of a sell-off, a bit of weakness wouldn't be a bad thing, because a lot of people have got cash on the sidelines that they're looking to put to work. And if you're a long-term investor looking to buy more or put capital to work, well, you don't want the market at an all-time high. You want corrections, you want volatility, you want a bit of weakness so that you can get set. So there very much is a silver lining, and I wouldn't be surprised if you do see a few ups and downs over the next little while. We certainly are entering that time of year when you often do see a little bit more, a few more ups and downs across the market. It tends to be a bit more of a volatile period as you head into that sort of April, May, June period, sort of through to maybe September, October-ish. All right, so like I said at the start, you won't hear from me for a couple of weeks. If you've got children, enjoy the school holidays. I certainly will, and then we will come back refreshed and ready to go in late April, maybe early May. Thanks for listening, team. We'll talk again soon.